So,
welcome, everybody. So thanks so much for joining us. Catalytic Capital for Climate Adaptation and Social Equity. I'm David Bank. It's great to see so many agents of impact on the call. So many people come each time, and so many new folks as well. So go ahead and start introducing yourself as something of a tradition on these calls. Let me bring in my ImpactAlpha colleague, Amy Cortez from Brooklyn, who's taken the lead on all things climate and is our new editorial director to boot. Welcome, Amy. You're muted. You violated the first rule here.
sorry. Hi, everybody.
And we're trying to speed up the top of the show here so that we can get into the meat of it. But let me first let's bring in the guest, Amy, and then you and I let's do a little setup. So let's just say hello to Ben Njenga coming from Nairobi from Apollo Agriculture. Hi, Ben.
Hi, David.
Welcome. And Rekha Unnithan from Nuveen in New York. Thanks for joining us, Rekha.
Thanks for having me. Hi, everyone.
And Jay Ko from Lightsmith Group has been working on climate adaptation for quite a long time. Jay, I think you pulled off alongside the road on the way to spring break to be able to join us, so we appreciate that.
No, appreciate it. Great to be here, David and Zulema and Amy and all the rest of the agents of Jayco from Lightsmith, usually in New York City, but frequently on the road someplace.
Well, thank you. And then Songbae Lee, an old friend of ImpactAlpha, who we've known from your Calvert days and now at USAID. Welcome, Songbae.
Thanks a lot. Nice to be here. And shout out to Jen Price, CEO of Calvert Impact Capital, who I saw is participating today as well.
I saw her go across the screen as well. Welcome, Jen. And Gillian Marcelle from Resilience Capital Ventures. I think the screen behind you is New York, but you're in DC, Gillian?
That's right.
Welcome.
Hi, David.
Welcome to the call, and thanks for joining us. We'll also have a sort of special treat, sneak preview of a very interesting and exciting project we've been working on, a map of this kind of climate capital landscape with Eric Burlow, who'll come on after we have the conversation. Hi, Eric. Amy, we've been pushing on climate adaptation for a while, and particularly in the last few weeks as we got ready for this call. And we're trying to make sure that equity is at the center of the conversation. Just tell us a little bit, what you've been seeing, how that plays out in some of the deals and funds we've been looking at.
Yeah, well, I think one of the things we want to do on this call is make the case that, equity and really making sure the benefits reach the most vulnerable communities is really the key to unlocking climate solutions. And our thesis is that also drives alpha. So yeah, we're seeing people trying to center equity in their solutions as a way to have more effective solutions, and also to make sure that the people on the front lines that have very little to do often with the accumulation of greenhouse gases in the atmosphere are benefiting.
Great. ImpactAlpha. The other point that we've been seeing, which I think will come through, is that the disruption of climate change can also be a spur to the innovation for the solutions. And some of those solutions obviously needed long, separate or predating, the current climate issues. But in a way same way that COVID was a disruption that left behind some interesting innovations, and people are adapting now to Ukraine. So these climate adaptations turn out to be broadly useful. All right, let's jump right in and start with you, Ben. Coming from Nairobi. I will say to put you on the spot, when I was talking to an expert or one of my expert sources, and I said, what can be done to scale climate adaptation? He said, build 100 Apollo agricultures. So I said, oh, let's get Ben on this call. So tell us what you're seeing with your farmer clients, and let's start with just what they're experiencing from climate change and how that's affecting them.
Yeah, for sure. Thanks so much, David, and thanks for having me here. I'm happy to be speaking as an agent of impact, especially representing the smallholder farmers, who I usually say they're the hardest hit by the when you look at it from an impact point of view. But before I go to the specifics, maybe to just give you some kind of high-level context around like farmers, not only in Kenya but also in Africa at large, is that. As most of you know, is that most of the of the land in Africa is usually farmed by small scale farmers, and you find like almost in most countries, especially in Kenya, 80% of these farmers are smallholder farmers. And when you talk about smallholder farmers, these are very rural clients. They're also difficult to reach because they live in very remote locations, and they farm less land, which is almost on average than 3 acres. And also they operate in a very disorganized kind of supply chain. And in addition to that, you find like these farmers struggle in terms of accessing the capital or the credit that they need to be able to succeed, because they don't have some of the basic things like the financial histories. They can't be able to afford some of the upfront costs that are required in terms of investing in high return farming investments. And in that condition, it has made it so difficult in terms of the cost of acquiring and even servicing African farmers is too high. And I usually say that once it comes to thinking about exploring that problem from paper kind of tradition kind of ways in terms of paper business model, it doesn't work. And that is why I usually sometimes give this kind of clarification that for rural farmers in Kenya and in Africa, you might need almost 3,000 of them to be able to make almost the same level you make from one single farmer in the central United States. And that just tell you like the challenge around dealing with these farmers. And when you think from a climate cost point or either climate impact point of view, I still believe that smallholder farmers are very critical to climate change mitigation and even adaptation. Because what you see is that smallholder farmers are still producing way less compared to their counterparts in developed countries. And that low productivity is driving for more demand for more land. And that also pushes for more deforestation, because farmers need more land to be able to get more production rather than be able to kind of improve productivity on the small farm that they have. And then when you look at even the farming practices, there are still farming practices that are not promoting the increase of soil carbon that could be able to address some of the climate change. But also even lately, some of the climate change impacts have forced some of the farmers to, or either some of the things like changing even traditional planting periods that most farmers have been planting. Like this season, the rains just came in Easter, and traditionally farmers usually plant in mid of March. And that just tells you like that is kind of a shift that is happening even in farmers' mind. And we have seen farmers already planted in March, but the rains just came, and that means like all the crop they planted have died, and right now they have to go back to the farm to be able to plant again. And then at the end of the season, if the rain is not reliable, because most smallholder farmers are still depending on rain-fed agriculture, they'll end up with drought, and that drought will impact them in a way that they won't be able to achieve the results. And that season is usually everything for the farmer. Is food for their family, is also where they get income to pay school fees for their kids. And when that climate change impact them in a way that they can't be able to be able to achieve the production for the season, is a big challenge for these farmers to be able to continue farming and continue getting food for their families. So I'll be happy at a later point to speak about what we are doing at Apollo. But just speaking broadly about some of the challenges that we are seeing with small farmers on the ground, David.
Well, what are some of the interventions that the farmers are deploying that you're helping them gain access to?
Yeah, for sure. So David, as I mentioned, is that we have approached this problem from a point of developing technologies that help us to serve these farmers scalably and profitably. The solution, or either the innovations that we are bringing in, is in terms of that technology that we have been able to build, because the product that we give to these customers is already proven in most of the markets. Like, no, if you are able to provide these smallholder farmers with everything they need to succeed, so that is high quality seeds, enough fertilizer, insurance, so that they can be able to be protected in a bad season from a climate mitigation point of view, and also training so that they can adopt to better training methods that are able to promote even climate smart technologies. These farmers are able to succeed, and they're able to even double or triple their production. And once you help these farmers to be able to increase their production, you are able to reduce the demand for more land. So that way you are able to reduce even deforestation. And then the other thing is, once you put all those products together, we are able to overlay financing so that these farmers can be able to afford all these inputs when they are planting, because also of the challenge of affordability. And then once they get the access to all those inputs, they're able to pay slowly over the season until harvest, when these farmers can be able to earn from the produce and be able to pay back. And then also in that bundling of the service, we are also able to bundle those products that are important from a climate mitigation point of view, especially insurance. We know if you sell an insurance product on a standalone, a farmer might not be able to take it. They might say, oh, I'll pray to God so that I can be able to get rates. But when you bundle it with a service that they care about and they want, which is credit to afford the inputs that they need to succeed, those farmers are able to take on the insurance product. Last season, we had a big drought in most of the counties in Kenya, and we were happy that we carried the insurance product, and we saw some of the farmers who could have not be able to continue with farming getting an insurance payout from the insurance company. And that is a classical example on how you can bundle a service that helps to mitigate the risk these smallholder farmers will face, and they are not able to recover again. So getting an insurance payout from the insurance company helped that farmer to be able to farm again the following season.
Ben, what I wanted to press you on is the farmer's ability to repay, and therefore your ability to keep lending, and if presumably that it can be affected, as you said, by droughts and other climate-related disruptions. And so how can you create a good financing business, a sustainable financing business, if there's going to be climate disruptions that might affect their ability to repay?
Yeah, very good question, David. And what I would say is that what we have seen, in a case, we don't lend to the farmers actual cash, we give them the inputs. So they pick the actual inputs, and that enables us to make sure that we have been able to finance the customers with an actual productive asset. And what we usually see is that once farmers get those inputs and they're able to get value, because we have seen before Apollo, or before a farmer start using the Apollo package, those farmers are producing around 7.5 bags. Bags are ideally 90 kilo bags per acre. But once they start using the Apollo package, we see those farmers jumping up to 20, 25 bags in an acre in a good season. That is almost like 3.5x increase in terms of profit. So once the farmer is able to make that kind of return, those farmers definitely will be able to repay. And with the support of training so that they can be able to maximize their production, we have seen a lot of success, because you are giving a productive asset. If that farmer is supported to be able to achieve the returns, they will be able to pay you back. On the flip side is that getting the insurance product, it also gives us even confidence to be able to lend to these farmers without worrying about the risk, because you are able to transfer that risk to the insurance market. So that is one on the financing side, but also on the farmer side, in case there is that bad season because of drought or any other kind of risk as a result of climate change, the farmer will be able to get compensation from the insurance company that will end up to forgive the farmer's loan. So that is really help, because even farmer is not worried to invest in high returns investments because if they risk the loss, then they are not able to repay the loan. So it gives even the farmer the confidence to be able to invest, because they know if any risk outside their control happen, they will actually be compensated by the insurance company, and then they will be able to repay back the loan.
Great. Thank you so much, Ben. Stick around. There's a lot more to talk about, but I want to turn to Rekha Unnithan from Nuveen. And Rekha, this is a good setup because you at Nuveen have just, I want you to tell us about the Impact Fund, but you also made this $100 million commitment through the Shell Foundation for growth capital to some of the kinds of interventions that Ben is speaking of. So why don't you just tell us what Nuveen has been up to with the Impact Fund in particular, but more broadly, and then let's get into the Shell portfolio as well.
Sure. Thank you, David. And thanks everyone for your patient ear. I co-head the Nuveen private equity impact platform. And prior to launching, raising and closing our fund that you mentioned, David, we've been investing in growth companies globally for the past decade, focused on people and planet, but doing that on behalf of TIA, the parent company that owns Nuveen. And using that track record and kind of building conviction in this investment thesis around inclusive growth and resource efficiency, we launched our first fund that accepted capital outside of the TIA family through mainstream pensions and institutions. And we launched that fund at the beginning of the pandemic, unbeknownst to us that the pandemic would happen, but had a successful close and been actively investing from that strategy. Our strategy seeks to invest in themes of the low-income emerging customer and bringing basic products and services to that customer, things like financial services, health, education, and also in resource-efficient assets, investing in companies that are helping the climate change mitigation story in serving large value chains become cleaner, greener, and produce less waste. We take a climate adaptation and adaptive approach to all the investments that we make, because we just believe it makes good sense to know where you are and kind of chart a path towards a more resilient business operation, but also an experience for your customers. And the exciting part about our partnership with the Shell Foundation is that we are partnering with an institution that has a very much similar focus, particularly in global growth markets like India, Sub-Saharan Africa, around themes of helping adjust climate transition. So we obviously know that a lot of capital around impact investing has been raised in the climate change space, but we also know that a lot of that capital is very much focused on large-scale renewables, utility type projects, and in developed markets. We have had a very keen interest in serving the needs of other markets where the low-income emerging customer is very much part of that energy transition story. And so in partnering with the Shell Foundation, we have a collaboration to together look at themes where a continuum of capital is important in both founding, growing, and cultivating those businesses. Even prior to this partnership with Shell Foundation, we have backed companies in the climate finance, agriculture finance space. Samundati Agrofinance in particular, an Indian-based NBFC that we backed and led the Series B in 2019, is a company that has had grant capital from likes of Shell Foundation to help them analyze value chains and the right time to provide working capital and market linkages to the smallholder Indian farmer. And so we expect through our kind of more formal partnership with Shell Foundation to share pipeline with each other around areas of the market that they have seeded from a venture perspective, from a grant perspective, and business models that are really coming of age and need aligned growth capital. And so the idea is to information share, to bring Shell Foundation into companies that we back, to help those companies develop new products and services around the adaptation and mitigation themes, but also to look at companies that Shell Foundation has been a very important part of its early journey, and look at the type of growth capital they need to be able to kind of continue to scale that work in a commercial way. We are actively currently working on a ag tech and micro cold storage company in South Asia, where they're serving smallholder farmers already. And we hope that our partnership with Shell Foundation will allow the company to iterate even more on some new product designs and perhaps use various instruments to help validate unit economics around business models that will serve that same customer.
Great. Rekha, how does Nuveen think about climate justice and equity? And when you're going to some of these markets that maybe are low income, what does that mean for your returns?
Listen, we're very commercially focused investors. We take significant minority stakes in these growth companies that are typically growing at 20, 30, 50% CAGR year over year in terms of their revenue base, their scale. And so, the investors who invest in us, want to see growth equity returns. As I mentioned, we've been doing this for some time. So we've actually validated that the types of businesses that make sense for Nuveen's investment strategy are ones where unit economics are very clear. The investments have been de-risked by people who came before us, venture capital, earlier growth stage capital, but really have perfected a business model, have shown that commerciality and scale works, and our capital comes to significantly scale that work, right? So we are not, at the point we invest in companies, we are not talking about trade-offs. I'll give you a couple examples. In March of 2021, while COVID was very much a reality in South Asia, we put $30 million in Annapurna Microfinance, a well-established for-profit microfinance institution that serves bottom of the pyramid, low-income groups of women with both loans as well as insurance in the state of Odisha and some surrounding states. We put $30 million in, and following our lead in that round, another $70 million of capital was raised into the company to essentially help the company continue to serve the same customer base, but also develop ways to be more climate resilient in the future, to have adaptation as well as mitigation techniques in place. The company, as we speak, is not only going paperless and digital to reduce its impact from kind of disruptions from climate change, like more frequent and severe cyclones that hit the state of Odisha annually, but also designing products that are going to be very important to its customers, including a small-scale rooftop and distributed solar because of the lack of connectivity to the grid and disruptions there. We have also invested in companies like ABC Battery Technology here in the United States. It's a lead acid battery technology company, very much serving several use cases around developed and developing markets. But one of the use cases is allowing e-mobility through e-rickshaws and a transition away from fossil fuels, but not quite ready for the lithium-ion step change, but in some of the key emerging markets that we just talked about in South and Southeast Asia. And so at the end of the day, our thesis areas do take into account that the climate change problem is not just going to be solved by installing large-scale solar and hydro and other types of plants in developed markets, and those are a very important part of the overall equation. But through business models that are looking at mitigation and adaptation in a very conscious way.
Rekha, just help us understand like what kind of signal this represents in terms of institutional capital. I think Nuveen overall has something like $1.3 trillion assets under management. The impact fund is $200+ million. Are there opportunities here for the rest of Nuveen, and then are there opportunities also, for other institutional investors? How can this really get to the big pools of capital?
Yeah, I mean, the $200 million is in the Nuveen Global Impact Fund, but my team and our teams that kind of came before us have invested over $1 billion in private equity globally under these themes. So no small feat through a time where this was not the most popular thing to do. So I think just by being in this market early, having staying power in the market and backing business models over this past decade has, in our view, really shown that institutional investors can invest effectively, and so that we think that signaling power is really important. I think the other bit is, because we take a very commercial approach, we have been able to bring in new investors into our fund who have previously never invested in impact investing. They have invested in private equity, but they're pools of capital that are much more traditional that we are kind of helping bring, among other leaders in the space, helping bring fresh capital into the space. And I think Nuveen overall, as you may know, Nuveen's parent company, TIA, announced net zero goals in future years. There's significant parts of Nuveen, including our social choice bond fund, which do a lot of work in the green bond, blue bond, and social bond space. And so there, from an overall perspective, the idea is that Nuveen's presence in impact is one that's been there for a while, and our commitment is here to stay, because we find these markets extremely interesting, both from an impact as well as a return perspective. We also have a very well-established affordable housing preservation strategy, which is focused here in the United States, but continues to look at climate change, the very key element of it, because at the end of the day, you're managing and operating real assets, buildings, and you have an ability to reduce the carbon footprint of the building, reducing the OpEx, and then keeping rents low for low-income tenants here in the U.S.
Terrific. Thank you, Rekha, so much. That makes a good segue to Jay Ko from Lightsmith Group, who has just raised, I think, the first, or we always say in ImpactAlpha, one of the first, because someone comes to us and says that they were there first, but I think you may be the first climate adaptation and resilience private equity growth fund. So picking up on the themes from Rekha, you've just raised this. Is capital starting to flow to these ideas? And then you can tell us, obviously, the thesis of the fund.
Sure, of course. Thanks, David. It's great to be here, and welcome to all the agents of impact. It's wonderful to see so much interest in the adaptation and climate resilience area. So as you mentioned, David, the Lightsmith Group is considered to be, by the Climate Policy Initiative and others, one of the first, if not the very first, private investment strategy dedicated to adaptation and climate resilience. We've been working on the structure and the strategy since about 2015-16. We had first close on the fund in 2019 and announced our final close in January of this year at $185 million. So Lightsmith's Climate Resilience Partners Fund is focused on growth stage companies. Those are companies that have $5 to $100 million of revenue. As Rekha mentioned, we're looking at companies that are beyond the technology and initial customer adoption phase. We're looking to scale those companies dramatically and really take them global, particularly bringing them to developing countries and international markets so that they can actually address what is now going to be an accelerating, unfortunately, problem of physical climate risk and impact. So the thesis of the fund is basically a tools strategy. Lightsmith thinks that, unfortunately, climate change is here and will continue to unfold. If you believe the IPCC 6 assessment this summer, it's almost like 1.5 degrees is kind of table stakes. The next decade's worth of global warming is basically baked into the atmosphere. At 1.1 degrees, we have global problems like gigafires. We have fire tornadoes. 200 people died in developed Europe last year. You could have chosen the developing country continent on which you could actually have been flooded out last year. And this problem, unfortunately, is just going to continue to accelerate. So our view is that this creates an enormous both impact and investment opportunity, which is to find those companies that have technologies that can help to assess physical risk and impact of climate change and help to manage those physical risks and impacts. So Lightsmith will go out there and find those companies in supply chain analytics, in agricultural analytics, in digital mapping and geospatial information, in catastrophe risk modeling, weather analytics, around resilient food systems, around water management, efficiency, and harvesting, and then help them scale up dramatically by providing them growth capital, helping them orient at the climate adaptation and resilience challenge, and connect them with our network of global corporate and government relationships. So we've already begun doing that. Very excited that we've done at least 2 transactions already. Happy to talk about those. And may shortly, David, have some news about additional transactions that we can talk about in the near future as just a little teaser there for you. But really excited to be working with entrepreneurs globally that are interested in actually taking those solutions and scale up. I think it's really important to note at this stage, climate adaptation resilience remains extremely limited in private and public capital flows. It's still less than 8% of total climate finance. The numbers from last year track less than $500 million of private investment having anything to do with adaptation and climate resilience. So at $185 million of dedicated capital for resilience and adaptation, Lightsmith's fund is actually a meaningful first step forward in that space, but we certainly welcome all kinds of other investors to this space. We need to scale up the tools and technologies and projects to deal with adaptation and climate resilience, particularly, as you mentioned, for disadvantaged populations, for low-income countries, for vulnerable populations in developed countries, and to accelerate the scaling up and deployment of the technology as fast as possible. So happy to talk about some examples or to discuss further some of the other activities Lightsmith is engaged in this area, but really excited to be here.
Sure, we would love to hear about examples, but before you jump into that, can you talk just a little bit about the demand? Because part of what you're doing is connecting some of these solutions that exist, but may not be known by corporations and others that can use them. So what are you seeing on the demand side?
Yeah, so unfortunately, climate is affecting all kinds of existing types of risk. So we've had fire risk since we discovered fire. We've had drought and flood risk since we discovered weather, and they simply are becoming much, much more impactful. And so as a result of that, even though most of what people are experiencing or most of the solutions that we're seeing don't typically call themselves climate change anything today, they're managing water and drought risk, they're managing flood and fire risk, they're managing even healthcare diagnostics risk, right? So 5 years ago, childhood asthma was not at the top of your list of climate change impacts, but after lighting California on fire every year for the last 6 years and into the indefinite future, you have dramatically more respiratory ailment again among children and vulnerable populations. And so we think that medical diagnostics at Lightsmith is a growth investment that's going to be critical going forward to help us adapt to and build resilience to climate change. The fire example is one that I think is pretty well understood. 2018, the 10th largest utility in the United States of America, PG&E, went bankrupt, was convicted of multiple counts of homicide. The people that invested in their municipal bonds didn't think that they were betting on climate change fire risk. They thought they were betting that people in California would still want to have electricity 10 years from now. Spending in the surviving California utility, Southern California Edison, went from over $500 million on wildfire risk management in 2018 to over $1.2 billion per year at this stage and accelerating. And I don't think anyone on this call at least thinks that the challenge of wildfire risk is going down, not up. We think a substantial amount of that needed investment and spending will be focused on technology. We really need to first understand where is this risk going to go? How can we make active decisions about that for companies, for communities, for disadvantaged populations, for governments? And the first step to that is to figuring out how we actually manage and assess those risks today. So that's agricultural productivity risk, that's water risk, that's supply chain risk, that's healthcare risk, that's risk to the built environment. So for example, one of the companies, sorry, David, go ahead.
Well, I was just gonna ask you because the topic of the call is catalytic capital, and you benefited in the fundraising from some catalytic capital. So I want to actually surface that so people know what's at stake here, because there are these growth opportunities. Rekha mentioned them, and you've described them, but yet there's been a reluctance on the part of some investors to come in. Catalytic capital can help make that easier for them, I suppose. Just tell us briefly how that played out in your case.
Yeah, absolutely, David. So the Lightsmith was launched with the support of the Global Environment Facility and the Nordic Development Fund. So the idea of the CRAFT strategy, the growth equity focus on climate resilience technologies, was incubated at the Global Innovation Lab for Climate Finance that's run by the Climate Policy Initiative. I think there's a number of folks on this call from there. Then we had some grant support from the GEF and from Conservation International and the Nordic Development Fund to help bring the idea into execution. And the structure itself is a blended finance vehicle. So Lightsmith's Climate Growth Equity Fund has a junior layer of capital that's provided by, among others, the Nordic Development Fund, the Luxembourg government, the Rockefeller Foundation, and most recently, the Green Climate Fund of the UN itself. That's really catalyzed a substantial number of other investors into a senior layer of the fund to generate commercial return. And this is modeled after some of the early investment strategies and blended finance in renewable energy, for example. We think there's commercial returns that can be generated from the types of investments that we're doing, but there's a lot of perceived risk sometimes around first-time strategies, particularly in this new area of adaptation and resilience to climate change. We also have an aligned technical assistance facility to the fund that's designed specifically to address some of the equity issues that you've highlighted. So what that is designed to do with the support of the Nordic Development Fund and the US State Department is to accelerate the deployment of the technologies we're investing in, particularly into low-income countries and to small island developing states and into the vulnerable populations of other developed countries. So many of those countries and markets are typically too small or too poor for immediate deployment of commercial technology today, but by using grant funding, we can accelerate the deployment of that technology by piloting deployments of those technologies, by thinking about how to actually provide access to those solutions to lower income countries, and basically bringing the kind of cost basis you'll have several years from now back in time to today, so we can actually show that deployment right now. So an example of that is one of our first investments is a solar hydro panels company called Source Global. This produces a unique technology that in the form factor that looks like a solar electricity panel, but it generates from sunlight and air, pure drinking water under almost any atmospheric condition. It's been deployed most recently to the equity concern here in Navajo Nation, which is less than 30% pipe drinking water access and the highest per capita concentration of COVID during the crisis, and is now deploying localized, distributed, 100% sustainably generated drinking water to a population that's never really had piped access in that sense. We're in the process of piloting or developing pilots for deployment of that technology in Melanesia and some of the small island developing states that are at threat of sea level rise impacting their water table, with the support of some of the technical assistance facility that we talked about.
Great.
So it's again examples of bringing that technology to people that otherwise would not have access to it for some time.
Terrific, Jay. Thank you so much, and we look forward to the new deals as well. But and stick around. But let's bring in Songbae and the Catalytic Capital connection. Songbae, I know you know that well from your Calvert days, but I'm curious how at USAID you're thinking of helping facilitate some of these projects and ventures, and how the Catalytic Capital, public Catalytic Capital can play.
Yeah, thanks a lot, David. I mean, I think it's interesting being a donor, coming from a donor agency like USAID, our capital, whenever it's used for mobilizing private capital, would be considered catalytic. But I think I want to point out one thing, like Rekha mentioned, the continuum of capital, and where we play on that continuum, I think is very different than what we've heard so far from Rekha and Jay. But before I go to that, if Ben, I want to call out Ben, one of the panelists, if you're able to answer, I'd be curious, because I think part of my answer will be in the context of one way we can describe it is how what you do, Apollo does, and I'm a big fan of Apollo, I've been following you since my time at Calvert, and what One Acre Fund does would sound very similar if someone from One Acre Fund was on this call as well. But your business models are very different. One Acre Fund depends heavily on grants, whereas Apollo has been very successful in raising investment capital. And I'm wondering, what do you think the difference is between the two organizations and how you're able to operate with such different business models?
Yeah, thanks so much, Son. It's a very, very good question. So I'll start. We are very good friends with One Acre Fund, and we share a lot of data. Actually, when we started in 2016, we got some of the data sets to even learn from what they have been doing from them. And also one of our initial co-founder also used to work at One Acre Fund. But what I will say is that One Acre Fund has done a lot of work, and is what I said in terms of proving that if at all you provide everything that the farmer needs in terms of this complete bundle, the farmer has the ability to double or triple their production. And what I think has been missing is more around how do you get this proven product to these smallholder farmers in a truly profitable and scalable way? Because even if these products are proven, reaching to these farmers, as I mentioned, they are very difficult, they are very rural, they are very fragmented. And making that business more commercial, more scalable, and more profitable is the difficult part. And I think that is where we have been able to innovate around how do we use technology to be able to break that path. And that is where we have really seen a lot of success, like using mobile phones, where we could be able to use them to communicate to these customers, or either use mobile money to transact with every customer from anywhere. And then also using remote sensing and machine learning to be able to build credit profiles of these customers, so that we can be able to access and build credit scores, that we can be able to understand who is the farmer who can pay back a loan or not. And that fully automated in a way that today a farmer can apply a loan and their loans can be approved within an hour. This is something which was unheard of. Like you go to a bank or you go to other institutions, they will tell you they will take a week or 2 weeks, but by then the rains have already come and gone. So I think the way we have built the investments that we have been able to make in terms of building a technology platform that enable us to be able to take this proven product to the farmer's hand in a way that is truly commercial and truly profitable and scalable is where we have been able to see a lot of success.
Well, Songbae, let me turn it back on you. Let me turn it back on you, and then you obviously can say what you thought about that. But the question is, are the models kind of sequential? Can models move from needing grant and donor support and then move up into a more commercial kind of S curve, or are some markets and some customers and some places, always going to need, sort of in a sense, subsidy and aid? And
great setup. Yes and yes. So I think the first thing, like Rekha was also saying, some of their investments they're able to make at Nuveen because others have de-risked it. In some ways, maybe One Acre Fund has already de-risked this market, and now Apollo's coming in with new products, with new automation that they can do it profitably. This is still a big question, whether they can do it profitably and at scale, which is something I'm just very interested in seeing how it turns out. On the other hand, to the second part of your question, I do think there are segments, sectors like agriculture, segments like smallholder farmers and agricultural SMEs, where I have seen so far a continuous need for subsidy. So the two examples I wanted to make about that, where we are taking a private sector approach, mobilizing private capital, but we need a continuous need. We see a continuous need for subsidy for the foreseeable future. First will be Aceli Africa. Aceli Africa, it's a market incentive facility that works with existing lenders. So these are private sector for-profit lenders, but for whatever reasons we know are not lending to agricultural SMEs. So now Aceli Africa is 100% donor funded, and USAID is one of the anchor donors. And the goal there is to prove an efficient way to use subsidy to mobilize capital. And they have a target of 600 million over 5 years, 20% of that to be climate adaptation related. The other example is One Acre Fund. And I think the interesting thing there about One Acre Fund is this difficulty we have, even though we have blended finance, even though we have impact investing, we really have trouble with hybrid models, right? We like 100% negative return, a grant, or we like a 5% return if you're making a loan. What we don't like is an 80%, a negative 20% return, which basically for One Acre Fund means that they're generating enough revenue to cover 80% of their expenses. So you're going to have a higher return on your donor dollars for the impact that they generate. But it's challenging, and there's the distinction there is making revenue a target of One Acre Fund, but not profit. And because for One Acre Fund, versus Rekha saying that Nuveen is a very commercial organization, One Acre Fund at its very heart is a development organization, and they're going to put impact first, front and center, even if that means not generating a profit, which is the decision that they've made.
Gregg, thank you, Songbae. I think we want to bring in Gillian now as we're nearing the hour here already. Gillian, you have resilience in your name, Resilience Capital Ventures. And I know you think a lot about blended finance, but first tell us a little bit, what do you make of the conversation so far? You always have good observations, and we love to hear your comments on the conversation so far.
Thank you, Amy. So first of all, let me say thank you for the invitation. And what I'm going to do is I'm going to offer some observations, but anchor them within some very specific data, because I think that's important. So I'm using something called the Global Outlook on Financing for Sustainable Development, and maybe we can drop that in the chat after. So that document, it's produced by the OECD Development Center, and it estimates that there's a $5.7 trillion gap in financing the SDGs. So I'm going to repeat that, a $5 to $7 trillion gap in financing the SDGs. I met the ImpactAlpha folks some 4 years ago in response to a blog by Saron Cohen, where he said that the revolution in impact had been won. And so what I've been doing in the impact investment community is reminding folks about that $5 to $7 trillion gap. Because on this call, we've had fantastic examples that add up to $400 million. I've been working in full-time in a capital advisory practice after doing many things for the last 3.5 years. And my largest client, who works in the Caribbean and Central America, we've been able to raise $130 million to do clean energy financing in countries in the Caribbean and in Central America. And my point is that scaling and solving the misallocation of financial capital remains the challenge of the impact investing world. In addition to that, what we've heard from everyone who's spoken is that finance is not the thing that is actually going to solve the challenge. Every single speaker has spoken about other forms of capital that are not dollars. They've spoken about solution design. They've spoken about de-risking. They've spoken about understanding their customers. They've spoken, I think it was Rekha who spoke about the need to share these examples so that you can actually get to, no one really knows what's the size of the global financial investment sector. Some people estimate it at 150 trillion. These OECD folks estimated at some 400 trillion. Let's just say it's $250 trillion, right? Let's, pick a number. The global financial investment sector is $250 trillion. The challenge that we have is that there is a generational level of misallocation of where those dollars are going. So I'm always interested in trying to understand from the point of view of the finance and investment world, how do you solve for that? And my offering in terms of a solution is the BBB framework, in which I remind my finance colleagues that even if they're not making it clear, that what they're actually trying to do is to combine financial capital with other forms of capital. If you do not have knowledge capital, if you do not have social and cultural capital, the dollars are not going to go where they need to, and neither are they actually going to produce returns. I think it was Jay who spoke about the need to align perceived risks with actual risks. I mean, anybody in capital markets knows that that's the thing. But that's about judgment. That's about subjectivity. But in the last 5 to 10 years, we've heard people speaking about data. Zeros and ones don't help you to make a judgment about perceived risk and actual risk. When you listen to Ben, what you get is insight. That's an understanding of what you are doing. And so the only way that we are going to mobilize and redirect that $250 trillion is by figuring that out.
Gillian, let me press you on what we started at the top of the call about the alpha, so to speak, in equity, and whether the flip in the perception, as you said, of that term and that dynamic might be something that could unlock capital at scale. And the thesis is that if you want to do climate adaptation, certainly even climate mitigation, you're talking about everybody. You're talking about every community, every country. The scale is immense, and therefore possibly the opportunity is immense. And if you got the models right, the investment opportunity is immense. That, as everybody on this call knows, sounds good, but hasn't yet obtained in the real world. How far are we from that perceptual shift?
So I think the impact investment folks need to start listening to Larry Fink. You know, he says that this is the generational opportunity, and he's right. Of course, what may happen is that the decision-making processes from private equity firms and commercial banks and so on may not go to the places where true, genuine impact investors are going. So I keep coming back to the 250 trillion. Our challenge is to persuade and to be compelling in our analyses of why that $250 trillion needs to go to do climate mitigation and adaptation. And I think it was it Jay again who was talking about wildfires. You're either going to go because you perceive it as something where you're going to make a return, or you're going to go because the planetary conditions are going to not be suitable for people to live. So it's either negative motivation or positive motivation. And I actually think that what you have is a spectrum of motivations and strategies. And what we need to be doing, we as humanity, is making sure that you're shifting over time so that more dollars and more other forms of capital are being invested in the things that we need to do for humanity to be able to thrive and for the planet to heal.
Thank you, Gillian. We have a few minutes before the top of the hour. I'll just tell you, we're obviously going to go over and we'll continue the conversation, but obviously some people will have to leave. So I want to give our speakers a quick last word, and then we'll continue. But obviously, if you have to sign off, that's up to you. Let's start with Ben. And the one thing I meant to ask you, Ben, is I think you grew up on a farm, and your mother is still a farmer, and I want to know whether her farming has improved because of some of the things Apollo might have been able to offer.
Yeah, for sure, David. And I can say, like, my mom has improved in terms of her farming methods. I had to also take a different approach in terms of training her, not me going and telling her that you need to do this, you need to do this. But I had to actually have my own farm and be able to show her on how to be able to farm better, right? Because that is how farmers change their mindset. They believe by seeing and actually seeing it in practical sense, so that they can be able to do the transition in terms of their behavior. And what I would say is that I really like the conversation that is happening here. And the key thing is that we need to do something, and we need to do something now. So I spoke during the previous climate change session, and I think the big call is that we need to scale up these solutions. They need patient capital. They need a lot of capital so that we can be able to scale and be able to actually reach most of these people who are hugely impacted by climate change. And for us to do that, we have to work through partnership. We have to be able to work through like-minded investors so that we can be able to scale our solutions to be able to reach more and more of these people who need these climate solutions so that we can be able to succeed.
Thank you. Rekha?
Yeah.
No, I just wanted to give you the chance to wrap up, if you like, with a few thoughts.
Yeah, well, listen, I think a lot has been said. I actually really take to heart what Gillian was talking about. and some of the other speakers mentioned about, the quantum of capital needed versus the gap, and this perception gap, risk gap, all of these things. But listen, it is the job of folks like us and agents of impact at various stages of investment along the continuum in different pools of capital and risk appetite to help with the de-risking, right? Part of why I love doing this at Nuveen is because one, it has taken a long time to be able to build the risk appetite to do growth equity in impact at an institution that's very mainstream, a $1 trillion asset manager. And the impact that will come will be able to continue to de-risk new and emerging business models in new and emerging markets, and for customers that are emerging. And so some of that, call to action for us is, while I may not go and fund $1 million in the latest carbon capture investment, my job is to make sure that the investments we do address the kind of risk and return mismatches that institutions that are much larger scale that believe some of these things that are very innovative are not going to give them the returns, and kind of bust that myth. And so it is, but there's a lot more to do. I tend to agree.
Jay, I'm gonna set you up though, which I want you to take on this equity question and this low income and base of the pyramid challenge and opportunity, and whether those are really can become growth equity opportunities.
Yeah, maybe I'll just say two things there. One is, look, we've talked about climate as a huge risk, and it is, and it's going to be a reality in the next 10 years, period. And so I think that's something that everyone needs to sort of accept at this point, and your business decisions will be affected by that. Your community decisions, your personal decisions will be affected by that. And you can either prepare for that, which is what we want people to do, or experience it afterwards. The flip side of that is it's an enormous opportunity. It's probably the clearest opportunity that we can see in terms of the certainty that we face. I don't know what happens in Ukraine. I don't know what happens in the credit cycle. I don't know what happens in consumer behavior, but 10 years from now, the climate will have changed. And there will be demand for technologies to understand that. There'll be demand for solutions to end up with a better position at that point in time. And there'll be a dramatic need for those both to be available to the most vulnerable among us and the poorest among us. I think the commercial capital flow, the trillions of dollars we're talking about, are not going to be supplied by kind of artisanal sort of farm to table approaches. We need to scale dramatically incentives. And if the economy is coin operated, let's put coins in it and have it operate. So shifting the incentives for people to act in their best interest to do that by looking at data, looking at analytics, looking at solutions and scaling them, I think is our best chance to shift the bulk of the economy. But that component of the economy that really still remains the most vulnerable in developing countries, in our own countries, I think really needs to be addressed through other sets of instruments. So our technical assistance facility at Lightsmith, where we're focused on low-income countries, we're focused on the most vulnerable populations in small island developing states. We're focused not in the kind of expensive housing in Cape Town, but the schools and the disadvantaged populations there, or in the disadvantaged populations in other lower middle income countries. That's where I think grant funding can pilot, grant funding can deploy, and bring back in time the kind of cost structure that we're going to have a decade from now or at scale to people who can have it today. So I think, there are many solutions out there. The one thing I think that was said very early on was this is an enormous opportunity. So to those agents of impact that are out there, come to the adaptation climate resilience universe, start companies, scale companies, come and invest in the adaptation and climate resilience opportunity, because it is an enormous opportunity. The entire future will continue to change forever now, because climate change will continue to unfold through the end of the century. And the question is, what choices do we make? What technologies do we invest in? What investments are we scaling to address those questions? Because those questions will continue to come. So we think it's a great opportunity at Lightsmith. We really hope lots of other entrepreneurs and technologists and investors will join us in that. And in attacking the problem of the most vulnerable, I think there's other ways to take commercial capital, commercial technology, and apply it through grants, apply it through blended finance, work with people like USAID and others, like we're working with the US State Department and the NDF to deploy those faster in those places. So we look forward.
Great, thank you. Thank you. Songbae, very briefly, some final thoughts?
Yeah, you know, so we represent the catalytic capital, and I think we all understand that it has to be the commercial capital that Nuveen or Lightsmith represents to kind of make any crack reaching that gap in financing that we need. But this might be an unpopular opinion, but there's not enough catalytic capital to mobilize all that commercial capital that we need to address the financing gap. So to me, these are all important questions and efforts we're making, but for the real change to happen, I think it has to come through things like policy or regulation. The thing that Gillian said, not just finance itself is going to solve the problem, or to end with kind of adding to Jay's analogy, if it's a coin-operated economy, you know, there's not enough coins to put in there to get it to work. We have to kind of change the whole structure of the vending machine.
Okay, and Gillian, you get the last word very briefly, and then we'll let everybody go. But we're stick around for this for the conversation, but also for this demo of this very cool climate finance map. So Gillian, just send us off.
So thanks, David. I think I'm gonna give a call to action that focuses on three S's that I heard in this conversation. One is the need to scale. So that's the first S. The second is the need to support and encourage solution design, because there are lots of solutions, and that needs both financial capital and other sorts of capital, but the solutions exist and we need to find them where they are, and they are around all over the world. And then the final one is really to share, because I think that the folks on this panel, this has been a particularly good panel, because I think for those of us who spend time in that ESG conversation, which is increasingly becoming circular and useless, this has been very refreshing, because at least you have people who are minded to tackle problems, as opposed to coming up with more reasons why either, you know, corporations are evil or regulation is required. You know, if the impact community can keep their eye on the ball and have a certain kind of almost spokespeople to encourage and to mobilize that $250 trillion that I made up as the size of the financial sector, I think that we can solve this, but it does require a certain kind of leadership. And I think that, you know, a lot of that has been on display across this conversation for the last hour. So thank you again for the invitation to be part of thinking about these issues with an objective of actually doing something sensible that makes a difference, as opposed to, you know, endless rounds of nomenclature discussions and debates.
Thank you, Gillian. Scale, solutions, and share, and then the L, leadership. Thank you. Okay, I want to thank all the speakers. I want to thank all the participants. Obviously, if you have to leave, that's fine. But do stick around. And the good segue, perhaps, is Eric Burlow. Where are you? I don't see you on my screen. There you are. I'll shut myself up and I'll put myself on mute. And if you want to show people what you've been working on, I think they'll be very interested. And then let's open it up to and everybody can just chat, and you don't need to be called on. You can even pipe up, or you can obviously put things in the chat. Maybe I'll have a chance to look through the chat while I watch while we listen to Eric.
Yeah, sure. Hey everybody, and I'll try to be brief because I realize we're running over here. My name is Eric Burlow. I'm an ecologist and a complexity scientist, and I run a small social impact data science group called Vibrant Data Labs. I've been working with ImpactAlpha, trying to synthesize all the data on private funding for climate in the United States to identify catalytic capital opportunities. And so I'm just going to share with you a 5-minute sneak preview of what we're working on. We're hoping to get it out on the ImpactAlpha site and looking for feedback in the next couple of months. So I will share my screen really quickly. Okay, so do you see a blank screen? Okay, great. Let's see. So one area that we are trying to explore in the data was this intersection where climate equity funding fills a critical gap at the intersection of mitigation and adaptation. And so here's what we did. We searched Crunchbase and Candid, which is formerly GuideStar, for all private investments in grants to any companies or nonprofits that mentioned any of about 150 climate search terms that span both the range from climate mitigation to climate adaptation. And we can share what those terms with you. We focused on US-based companies and nonprofits, mostly because of the data set is very US biased, and also funding in the past 5 years. We're actually currently also working with RTI International on making an international version of this as well. So stay tuned for that. So even with just that US focus, we found over $240 billion worth of private funding to over 7,000 companies and nonprofits, US based in the United States. Yeah. And for each of those, what we did was we dove in and we mined not just the descriptions from Candid and Crunchbase, but also from LinkedIn, if available, and also their website. And from that, we partnered with a natural language processing company called Primer to machine read all that language from 7,000 companies and build an ontology, a taxonomy of keywords that are climate relevant for each organization, like batteries, energy storage, renewable energy, and like a hierarchy of keywords. And then given that set of keywords, it allowed us to use machine learning to let all those organizations self-huddle into groups to define broad themes across that landscape. Oh, I can't seem to, there we go. So each of these bubbles is a group of organizations that are similar to one another that huddle together, and they're labeled by the most common keywords in the group, like transportation, mobility, public transport, or renewable energy, solar energy efficiency, food security, natural disasters, etc. This is a really unique big picture thematic view of the funding landscape that comes not from what the funders say they're doing, but from what the doers, how they describe what they do from their language. It's impossible to see these patterns with just the naked brain scanning 7,000 company descriptions. So I just want to point that out. And then once we have things in a bubbles, what we can do with it, which is pretty unique, is we can start looking at patterns across the themes. So we have, for example, every organization we know if it's grant funded or early venture or late venture. That means that for every bubble, we can calculate the fraction of entities that are venture funded versus grant funded and look and instantly see the concentration of venture capital in a small corner of that problem space. So for example, if we zoom into the ones that have the highest fraction of venture, we can see those tend to be issues, companies working in renewable energy, solar, electric vehicles, e-mobility. But if we zoom back out, we see there's a big swath of gray grant-dominated themes that, don't seem to have clear business models. Relevant to our conversation today, many of those are themes, if we go to the far end of the spectrum, mostly grant-dominated, many of them are adaptation related, like natural disasters, extreme weather, food security, other ones like water and natural resources. So if you look at those and you summarize all the keywords in those themes, like the top ones on the left there, they include a lot of climate equity terms like justice, poverty, jobs, food security, vulnerability, and human rights. And so this led us to think maybe we could take all of these different themes, and in addition to tagging them if they're venture or not, we can also tag them whether or not they mention any climate equity related terms. And these were any terms in this list like poverty, inequality, accessibility, rural inclusion, and et cetera, et cetera. So this is modifiable if we want, but the idea was to have a sense of like, what is the landscape of equity related investments? And once we do that, we can look for every one of these bubbles, what's the fraction of equity related organizations and what's the fraction of venture related ones, and plot them together. So this is kind of a first ever view of that relationship between equity funding and venture funding, which appear to be exactly inversely related. So here, every dot is one of those bubbles of clusters of companies or organizations that are similar to one another in a theme. On the x-axis is the fraction of organizations in that theme that are venture funded. On the y-axis is the fraction that mention any equity-related terms that in our list. And the size of the bubble is the total amount of funding to that theme. So here's this direct inverse relationship between the fraction funded by venture, the fraction that mentioned equity. So there's an equity gap in the venture funding for sure, but there's also interesting anomalies or outliers that present opportunities. So let's go to each end of the spectrum. For example, if we focus on renewable energy and solar and zoom into it, and then kind of explode that group into all the organizations within it. We could subset the outliers in there that are equity. These are mostly non-equity mentioning things, but there's a subset, 174 of the almost 1,000 companies that mention equity, and a small subset of that, 31 of them that are venture funded. If we look at those, we can see that the top keywords that they mention have to do with energy poverty and energy access. And they include companies like SparkMeter that offers low-cost metering solutions for microgrids in rural areas to make access to electricity possible in hard-to-reach places and underserved markets. Okay, so this is just a recurring theme in that part of the spectrum of renewable energy, that the small fraction of ones that are equity-related, excuse me, tend to be around energy access and independence at the intersection of climate resilience and climate mitigation. At the other end of the spectrum, we've got up in the upper left, ones that have very low, like less than 10% of them are venture funded, but over 80% mention equity terms. We have things like food security and agriculture. If we zoom into that theme and it explode it into its individual organizations, we can also identify the outliers here of the, of the 568 that are in this theme of food security and agriculture, only 31 are venture funded. If we summarize those, they include things like freight farms, which really interesting. They upcycle shipping containers for hydroponics to support farming in areas of the world that where the climate doesn't support traditional farming methods to provide food access in those areas. If we look at all 31 of those venture-backed outliers in a equity-dominated theme, we can see that dominant keywords include managing food waste, addressing the food system, and regenerative agriculture. There's, and also data for optimized farming. There's about 123 investors of those 31 entities. Here they are listed in order of frequency. And just an example that with access to the data, if I wanted to convene a group of investors that are kind of at the cutting edge of business models for food security at the intersection of climate adaptation, here might be some people to talk to. So just zooming back out, this is just our first stab at a big picture view of the climate funding landscape. We, in the United States, we're working on an international version with RTI, and we plan to be launching this publicly on the ImpactAlpha site, and welcome anybody here, if you know of anybody who would like to be a guinea pig for feedback and be open to a demo. We're actively seeking feedback in the next couple of months. Thank you.
Thank you, Eric. I think that'll whet folks' appetite, and then you can reach out through us, and we'll through editor at ImpactAlpha or info at ImpactAlpha. You guys know how to reach us, and we're very excited to be working on this, as Eric said, and RTI is helping us pull additional data and pull it together. So thank you. And I see you kept the audience there even past the hour, Eric. So kudos to you. As I said, I'm gonna take myself out of the picture here. Amy, I don't know whether you've had a chance to look through whether anything pops out of the chat, but I'm gonna try to keep myself on mute. We'll see if I succeed.
Yeah, I haven't had a chance to really peruse, but this is the opportunity for anyone who has any comments they want to make or questions of anyone to just hop in.
To bring up something to you, Eric, since this is probably something you can immediately answer, that people have asked, what geographies are you covering? And more broadly, how are you handling issues around data quality that you have access? Have you been able to at least get estimates for unlisted projects or any of that? Because even the OECD had to do such estimates in order to figure out how much more under current rules could be invested in climate smart infrastructure, for example. And what they found was that only $1 trillion at the moment as of 2019, 2020, but even under existing rules that can go up 10 times. So have you done that type of inference, or have you not, Eric?
I'm not sure that the inference being an estimate of what, just to.
So in terms of that, you're going to have situations in which you have either unlisted deal flow for one, or that the amount of data and the granularity of data might not be to the level one might be expect in, say, the States or Europe compared to many other regions.
Yes, no, exactly. That's a really good question. So there's two parts of it. One is that, as I mentioned at the start, we focused on US-based organizations in part because the data from Crunchbase and Candid, which was formerly GuideStar, is very US focused. Many of them work in areas of the world that are not the United States, and we can extract that from the text if they mention, like Kenya in their description, even though they're based in Massachusetts, we can geotag them as that. But they're all US based in this particular data set. Even that is incomplete. They're just what we can find in Crunchbase and GuideStar. More recent things, really recent, won't be in there, of course, or that weren't listed. Or if they didn't mention in their descriptions any of the terms that we search for, but the whole thing is updatable. Like it's meant to be revisable, updatable. If we see something's missing or search terms where we need to update, we can do it and rerun it. That said, we will always miss something. So one of the things we need to try to build in is the ability for people to manually suggest, oh, you missed this, you missed that, or here's a portfolio that wasn't fully complete in there, that we can add it in. That said, I've done a lot of random sampling of that data. In other words, like randomly deleting some of it, knowing that there's errors, to see whether the broad patterns are consistent. And those patterns are pretty rock solid. Like still all the venture funding goes to renewable energy, batteries, and electric vehicles, right? I mean, the vast majority of it. And it doesn't matter whether the data are a little bit incomplete, we still see those trends. So part of it is robust to errors in the data in terms of broad themes, broad trends. But for sure, if you poke around, you're going to find something that's not there, that you're like, why isn't this here? It should be, or something might be in there that met a search term, but seems a little bit irrelevant, So it's kind of like, yeah, all of the above, I guess I would say. But part of our goal is to really have a way to get feedback, flag errors, correct it and rerun it.
Somewhat like a graph of what the OECD did a couple of years back, trying to track all of the regional investment flows. Is that what you're trying to achieve?
Yeah, and also we're trying to get, there's two parts of it. One is, what are the flows? Who got funded? But then the next step is, how do you enrich that to say who's working on what, where? Right? That's not a list of who got funded, doesn't tell you what are all the themes, where's the money flowing in which themes are bigger than others, which ones have more grants, which ones have, mature business models. And that requires the language of what everybody's doing to start seeing those patterns. So, yeah.
Valerie, you had your hand up twice, actually.
Hey, Njenga. Hi, Eric Berlo. It's amazing to see this model. And because I've been in a lot of conversation with policymakers who have sort of been concerned with, grants dispatched for climate being co-opted, by people who use them for, profit and other, instead of serving their prime purpose. I'm wondering if that's something you're looking at, because I see a huge need when it comes to public capital or capital that is government related, to create transparency at this level. I know it's a major concern of legislators in Congress. And so I would be very interested in you bringing this type of thinking to that area.
Great point. Yeah, go ahead, David.
I was just going to say, the question came up about global coverage, and I think RTI is helping us pull that together. Yeah. Is there somebody, Avery? I don't know if you're still on, or anybody from RTI.
Yep, I'm still here.
So just wanted to give you a chance to chime in about global data or what have you on.
Yeah, so this is one of the aspects that we're working on right now, where we're trying to cull together what are the different data sources that we can use. And as we know, it is a bit more challenging on the global side to try and find some of these sources. So we're reaching out to different folks in the industry in this space and trying to see where it could be coming from, and to reflect on some of the questions that you're answering that. So right now we're doing the landscape and trying to think about how best to fill some of those gaps. And then where there are huge gaps, how do we also collectively as a community start to fill that and think about where do we have additional data needs, and how can we begin to work with other donors to fill that and bring that information in.
Right. Yeah, good point. And that's particularly true. You mentioned the grants data. I think like the data that we're showing here is private grants, private philanthropy, but not government grants. And I'd like be thrilled to do this with government grant data. I just didn't have it in this data set, but the same method absolutely can apply. It's often the type of data is pretty similar. And the idea again is to have transparency, who's funding what where. And there is no data readily available on impact or who misused funds or whatever, but you can find who funded whom and talk to them, and say, hey, what did you learn? I heard these people misuse their funds. Who else did you fund? Who do you know? So part of it is to facilitate conversation for that missing area where data just isn't available.
And Tanuja, you had a question.
Yeah, hi everyone. Thank you very much, Eric, and thank you, David. So this is a request, please. I too am a complexity scientist, and it's good to hear scientists speaking rather than just a finance person. Sorry. I suspect that if we were to apply, no, let me step back a bit. So much has been said today about money, how much is available, how much is not available, how much has flown into this area and how much not. But I suspect that if we were to apply complex systems theories to understand what is needed where, in what scales, right? So I'm referring to a fractal application. Then the actual funding required and actual time required to effect change will be a lot smaller than we're thinking now.
Mm-hmm. And that's a catalytic capital question as well, I think, as you're putting it, which is that you can spark additional capital with the right applications. And actually, that's what I'm interested in, Eric, in how that plays out, because this was a question I asked Songbae. Is there a progression from one kind of funding to another, or are some applications and markets or what have you, going to always be in a sort of more grant or donor funded side, and others will be more commercial?
Right. I mean, I think there's the individual organizations that are, more, let's say, will always stay a grant fund. They won't have a business model that'll be grant funded, but a particular topic can change over time. I mean, even if you look at electric vehicles, 20 years ago, those were grant funded research organizations around technology, et cetera, et cetera.
We always like to point out that some of Tesla's first investment came from what would be called an impact fund, now DBL, but at the time called the Bay Area Equity Fund, I believe.
Yeah, and just even policy, subsidy, the other kinds of incentives for doing that, the research, et cetera, et cetera. So there's a lot of stuff that early on was totally a grant funded theme, and then over time there was the maturation of business models for some part of that.
So I wanted to jump in here because I think that there is, and so David, to speak to your point about, I think, drawing on our complexity scientists and so on, it's not so much about doing things sequentially. It is about applying and deploying the types of capital where they are needed. And they may actually be needed in combination, not sequentially. And the other thing is around vocabularies, because very often there are forms of capital embedded in a financial capital product. You can't actually design a financial capital product without knowledge capital. And so the idea of sort of, having to split it out, it's just simply that the conventional definitions of blended finance are very limited. They speak about sources of financial capital, public and private, and they make very rigid distinctions between types of capital, where in fact those boundaries are much more porous in day-to-day life, right? And in reality of how commercial finance works. Big banks call in specialists to tell them where to invest. That's not about financial capital, that's about knowledge capital, but no one splits that out. So I think that the point about different forms of capital and how we're doing that, but in parts of the world, and that includes in wealthy countries, where you have to do remediation, where you have to heal from harms that have been done, you might need a traditional grant to take that on, just to do the research, to figure out what form, how much damage has been done, or to estimate what would you have to do for the, I love the example of the childhood asthma rates.
Is it Rajashri? Do I have that right? You have your hand up?
Yes, thanks, David. I just wanted to know, when is this database getting published on the website? Do you have a date in mind?
I wish I could tell you more specifically, but we're working to figure out a way to integrate it in a kind of visual and useful way, and also to augment the data, as Eric said. So it'll be in the, let's see, what are we? We're already in 2Q. We hope it's in 2Q before the middle of the year, before the summer. But we'll certainly let you know in ImpactAlpha.
Good. Thank you so much.
Also, Aubrey is also here. She actually pointed out to some international data sources that if she's still here, hopefully she can intervene.
Yeah, no, I'm happy to say a couple things there. One, everyone can look at Brighter Bridges online. They have their innovation maps. They'll show you in each sector which companies have been funded. But even more granular is a database that was built out by Green Tech Capital and a guy named Maxime Bayen. And now it's renamed The Big Deal, but it's a database of every venture deal that's been done in African markets since 2019, by investor, by sector. So those type of things could inform some of the data. You're gonna have to blend it to some extent, but I think those are two phenomenal sources that I use almost every day.
Terrific. Now would be the time to pipe up, or we've gone half an hour over, which is a testament. I usually wait till it gets down a little lower than this, but you all are hanging on, hardcore agents of impact. But if anybody wants to have some final comments, now would be the time to pipe up.
It's an open source platform, Eric, that can interoperate with the various data sources, whether it's something Aubrey presented or any other data source we come across, since that is going to be a big concern going forward.
Yeah, I mean, that's the hope. Right now, it's kind of more of a prototype that's fixated on these couple of data sources, but generally these types of data are pretty similar format. So it's just a matter of, the resources to make that possible, really. the code on it is all open source, though it's a lot of work just to get it to spit out meaningful things.
Okay, well, let's let it go at that. We'll come back obviously with this map, which I knew everybody would get a kick out of, and it will be very useful and insight, generate a lot of insights going forward. So we're very excited about this project with Eric. Thank you everybody who joined the call. Thank you, of course, to the speakers. Thank you to the whole ImpactAlpha team that puts these on. Stay tuned for the next one coming up in May, which we'll give you the full details of as soon as we pull them together. Amy, you have any last thoughts to send folks off?
No, I'm good. Just happy almost Earth Day, everyone.
Indeed, indeed, and do take advantage of that subscription offer, and keep watching your brief every morning for updates on all of these things. So with that, we're down to 50. That's what when we get to 50, I think it's time to say goodbye. But thanks for hanging in there.
Bye, everyone.
Bye bye.